So we thought after talking about the changing structure of financial intermediation, some of the risks and opportunities involved with them, some of the new tools that are being discussed to assess those things, we thought it'd be appropriate to talk about in some detail some central bank tools. So in our fireside chat today, Bill and I are going to talk about central bank tools, specifically including backstops to address threats to financial stability in the context of growing non-bank financial intermediation. And my first question for you, Bill, is in the G30 report on bank failures and contagion that you directed last year, you argued that resilience should be the first line of defense for those threats, and something I agree with completely. And that improved backstops, for example, liquidity or LR facilities, as the name implies, and others should be the last line of defense. So how should we think about those principles for non-bank firms, for markets, and for the financial system?
So
probably spend the rest of our time talking about that.
So I think, the problem is that the non-bank sector is different than the banking sector because it's not, a lot of it's not regulated, or certainly not regulated from a safety and soundness perspective. I mean, there are some regulated pockets, but safety and soundness is not really the focus. And so you really have to ask yourself the question, if the government is going to take the tail, what's the quid pro quo for that?
Correct.
For banking, there's a lot of quid pro quos. You've got to do a lot of things that the government asks you to do in terms of capital liquidity. And in exchange for that, you get deposit insurance and you have a discount window. And so there seems like a reasonable trade-off. The problem that we have, of course, and that this is sort of a subtext of all the conversations today, is that when we had the great financial crisis and we decided that we didn't want banks to fail, we had to ratchet up the capital liquidity stress testing requirements. And that made banks in a bunch of areas not competitive with non-banks. And so, of course, the activity goes out into the non-bank sector. The problem with that is you can have a safer banking system, but you can have a less safe financial system if you carry that to its sort of logical conclusion. So I always ask myself the question, how can we make the banking system safe, but without making the banking system less competitive? This is why, for example, last year with the Group of 30 paper that we did with Stein Clauses, who was here earlier, he held the pen, and myself and a bunch of other people sort of helped him. We basically proposed that one way to strengthen the banking system is to have a better lender of last resort function. And one way to do that is actually require banks to pledge collateral at the discount window equal to all their runnable liabilities. And if you do that, then people probably won't run in the first place because they'll always be sure that the bank can turn their liabilities into cash, and that's a good way of going. But for the non-bank sector, how do you do that in a way that you're not just creating moral hazard? That's the sort of the rub. So I think the margins you have to work on for the non-bank financial sector are quite different than the margins you can work on for the bank sector. I think the margins that I'd be working on would be, number one, a lot more transparency. I mean, I look at Archegos, I mean, a great example. If people had known what Archegos positions were, their positions probably would have been 25% of what they actually turned out to be.
Or less.
Or less. And obviously, stock prices of the companies that they were invested in would also be a lot lower because they would have been able to buy some up shares. And so the whole thing would have been just probably wouldn't have even happened. So a lot more transparency, I think, is really important. Second thing I think you need for the non-bank financial sector is a lot more transparency, not just about the end investors, but also all the intermediaries. People ask me all the time, how worried are you about the non-bank financial sector? And I say, well, I'm worried because I don't really know what's there, and I don't really know what's going to happen when it's stressed. And I particularly don't know what assumptions people are operating under that will turn out to be incorrect. I mean, if you really think about the things that went wrong during the great financial crisis, it was a whole series of assumptions that people held strongly that turned out to be absolutely incorrect. And the problem with that is when you go from thinking the world's like this to the world's like this, then obviously everything you've done up to that point is wrong, and you have to recalibrate. So during the GFC, think about it, subprime lending is safe. I mean, it's safe as long as home prices are going up. But if home prices are going up because of subprime lending, well, you're going to obviously have a problem at some point. AAA rated CDOs are safe. because they're going to be uncorrelated. Well, no, they're not always uncorrelated. If housing prices go down collectively, then AAA CDOs are actually pretty darn risky. So when I look at the non-bank sector, I guess, one, a lot more transparency. Two, I'd like to really focus on run risk, because it seems to me like the thing that really generates financial crisis too is not just the initial shock and the remarking of the assets. It's when people actually have to start shedding positions. And then that causes prices go down further, which causes greater losses, which create these feedback loops that I think are particularly dangerous. Now, the non-bank financial sector, I mean, we're generalized, but let's talk about, the private equity kind of funds and stuff like that. I think that's really the part that we're really talking about. The good news is they say they can put up gates, and therefore that can sort of short circuit the fire sale of assets. And I think that's a good thing. But what I worry about there is if their investors think the gates are most of the time going to be down, and then the gates go up, having you just push the liquidity problem downstream to the end investors. And you see that right today with Harvard, right? Harvard University is obviously got a lot of issues with the Trump administration, but I saw that they were doing a big sale of some private equity tranche because obviously they think they need to bolster the liquidity. You really don't really want to have to do forced asset sales to obtain liquidity. So I think figuring out how the downstream liquidity works to the end investors, I think would be something that would be very, very useful. But transparency, I think, is the number one thing. I mean, if you don't know what it is, how do you know how big a problem you have?
So 2 years ago, we saw how inflation and tighter monetary policy exposed funding risks in banks and in non-bank financial firms. And as you just said, non-bank financial firms rely to a greater extent than banks on runnable liabilities for funding. Are there ways to think about limiting the contagion in them? Are there ways to create incentives to encourage these institutions to choose less risky funding structures? In other words, create the incentives for them to do that. And then last, and I think you and I know the answer to this one, which is there a case for liquidity support mechanisms for these institutions? What are the pros and cons, including increased moral hazard, for such a regime? Because we just heard from Nat today that at their discretion, the Bank of England has created a contingent funding mechanism for insurance companies' pension funds with long duration assets and liabilities, but it's at their discretion. So it's not like they're going to rush in automatically. But where do we draw? How do we draw the line in thinking about those things?
Yeah, it's a tricky question because at the end of the day, the government's always going to take the tail, and the question is just really where do you draw the line? And to say you can't credibly say no, we're just going to stand here and let the whole thing blow up. It's just not. So you can pretend that you're not going to come in, but the reality is everybody knows you're going to come in. And for banks, as I said, there's a quid pro quo. So we're giving you this liquidity facility, and you in exchange have to do all these things. For the non-banks, it's like, what am I getting for what I'm giving you? And maybe you need to think a little bit more about that. We'll offer this thing to you,
right?
But in exchange for offering this thing to you, you have to do certain things. I mean, you could make it much more explicit. There's a quid pro quo for offering that thing. My personal opinion is I really prefer things that are set up ex ante rather than ex post. I mean, the Fed typically does things so things blow up and then the Fed runs to the rescue.
Right.
Because when you're having the conversation about why we want to do this thing ex ante, people always say, well, how do you know? I've had this conversation many times with people have said, how do you know that it's going to be bad? I said, I don't know it's going to be bad, but if it is bad, you'll be glad that you did this thing. Doing it ex ante, I think, is great because it basically can reassure everybody that they don't have to actually run in the first place. One of the questions I sort of had when we've seen those other panels present was when there is an event, a liquidity, some sort of shock to the system. It's not just that liquidity is used up. Desired liquidity, because of the shock, also increases. I mean, the best example of that was when we had the problem in 2019 when the Fed drove the amount of reserves below the level that banks desired on the first day, and everyone was surprised by that, a spike in repo rates. Well, what happened on day two? Every bank said, I need more liquidity than I thought I needed. And so that just sort of kept you going through the process. So you need something that's there ex ante that reassures people that you can go there without limit. And the only, and the reality is that in all these discussions, the only person that has that ability to have an elastic balance sheet is the central bank. I mean, that's why the Federal Reserve was established after the banking crisis in 1907, because relying on JP Morgan to bail out the banking system was probably not a great.
It worked once.
Well, it sort of worked. I mean, they still had a banking panic. So I think, the Fed is the only one that has an elastic balance sheet. And so why don't we just sort of recognize that and try to build it into the system in a more fundamental way. I mean, when we're talking about, treasury market function earlier, one of the problems you have in terms of treasury market function is that when the algorithmic trading firms withdraw from the market and everyone says, oh, let's go to the primary dealers and trade with them. Well, the primary dealers have already allocated their balance sheet to other things. They're not holding a bunch of their balance sheets sort of in reserve for this 1 out of 100 day or 1 out of 1,000 day event when their balance sheet might be needed for treasury trading. That balance sheet has already been spoken for. So no one can really expect them to come in at that point. Only the Fed can really supply the liquidity. So my view is the one area where I would be willing to provide backstop that's available to all is the U.S. Treasury market. Because if you provide a backstop to the U.S. Treasury market, the benefits of that backstop accrue to the U.S. Treasury. In other words, if people value the ability to take securities to the Fed, Treasury securities to the Fed to obtain cash, if they think that's worth a useful thing, then they're going to be more inclined to hold Treasury securities, and Treasury yields are going to be lower as a consequence. So it seems to me that's a great example of where there is really no moral hazard. So I think my view is I'd like to make the standing repo facility open to everybody, and I would structure it so that the primary dealers were just a pass through. They didn't actually take it on their balance sheet. They're just sort of agents using their plumbing to take the securities from the end investor and pass it on to the Fed. And if you did that, the chances of dashing for cash out of the treasury market would be diminished because you wouldn't feel like I need to raise the cash today. You'd be like, well, I don't need the cash today and I can get the cash tomorrow for sure. I'll just wait and see how things go rather than panicking on day one.
Yeah, well, we've been talking about expanded use of the SRF for a long time. And
well, the Fed's got to be willing to sort of push it. I mean, my view of the standing repo facility today is not really very functional. And I know for a fact one very large bank has basically said they won't use it,
right,
because they view it as being stigmatized. Now, this is an example where you actually want to bring the supervisory people on board and say, if you don't use the standing repo facility, you're in a lot of trouble because that's bad risk management. That's what it's there for.
Yeah. And it's analogous to what we've seen with banks who
don't want to go to the discount.
Don't want to go to the discount window.
I mean, the discount window I sort of understand because the discount window is a higher level.
And the supervisors have discouraged its use.
But it's also a more costly source of funding.
Right.
The standing repo facility, the only time you're supposed to use it is when it's cheaper than what you can actually obtain in the marketplace. So, I mean, in a crisis, the standing repo facility wouldn't be stigmatized because that would be the cheapest repo rate out there.
So let's come back to transparency. Can you be a little more specific about what kind of transparency you'd like to see? Pick a couple of NBFIs in which you'd like to see them, like PE, PC funds, or hedge funds. What would you like to see there?
Well, I'd like to see, one, I'd like to see the degree of leverage, the concentration positions. I'd also like to do a bunch of things on liquidity. For example, like I think it's ridiculous that high yield mutual bond funds get overnight liquidity. I think it's like almost costless to basically say if you're invested in a liquid asset class, you have to have liquidity that represents how liquid the asset class is. Because if you're in a liquid asset class and you really need overnight liquidity, that's really not the right asset class for you. You shouldn't be there, right? So it seems to me like that's a collective action problem. No individual firm wants to say, no, we're not going to give you overnight liquidity because everyone else is giving you overnight liquidity. But why couldn't the regulators just sit people down and say, no, it's all going to be 1 month liquidity for this kind of asset class, and it's going to be 1 week liquidity for this kind of asset class? And I don't think you'd really be disadvantaging the industry at all. You'd be actually making you'd actually be, essentially leveling the playing field of investors in those funds. Investors would no longer have to rush to the fund to pull their money out first on the fear that if I get there later, more assets will have been sold. The price of the assets that I'm invested in will be lower, and I'm going to be disadvantaged. If you have 1 month liquidity, then everyone gets paid out over a month at the same price. So it seems to me like it's also more equitable.
So what about stress testing these institutions? I mean, is there any way we could
I'm
think
not
about doing that?
really even sure how you would do it. I mean, because to the point that was made earlier today, that this is a very heterogeneous group of
Absolutely.
companies. And so I don't even know how you would do it. I think you could probably look at this issue of if the gates go up, who's disadvantaged by the gates going up, and sort of follow the money downstream and see what the liquidity needs are of the end investors and see whether they would be hurt by the gate. I mean, in some ways during the great financial crisis, the non-bank financial sector was mostly the dog that didn't bark, with the exception of AIGFP. But everyone was waiting for the hedge funds to blow up during the financial crisis. I know I was waiting for it. It never really happened because of the ability to either because they're following a lot of different strategies or because they have the ability to put gates up. It really turned out that the hedge funds were not really systemic, at least in my memory.
What about CCPs? Are they a special case deserving special attention?
Yeah, I mean, I think CCPs just need to be regulated, and they need to have
Well, they are regulated, but
but-
maybe insufficiently.
Well, I don't know. I mean, my personal view is, yeah, I mean, obviously CCPs are horribly important. And I think generally the track record of CCPs has been pretty darn good. I mean, we've taken them through a number of really, really significant stresses, and they've come through in, I wouldn't say quite flying colors, but with not much bruising. So I sort of think that it's working pretty well. I think I was a little nervous about the count that was made earlier today about let's have multiple CCPs competing with one another. I don't know. Competing with one another sounds like a risk of race to the bottom. Also, it seems to me like the biggest advantage of a CCP is you get to net down all the bilateral exposures. And if people are playing in different CCPs, you're going to lose some of that netting benefit. So I'd rather have one CCP for the whole market and regulate it like a utility. Now, the problem with that is the for-profit motive. I mean, go talk to CME about regulation.
I have.
I have too. It's not a pretty conversation.
Right.
And the fact that they're regulated by the CFTC is also a problem. I mean, I think the other issue in the non-bank financial sector is the regulators of a lot of these firms don't have a financial stability mandate.
Correct.
And I think another thing that you could probably do to make this thing work a little better is to have an explicit financial stability mandate that applied to these entities. Now maybe the FSOC is supposedly the one that has it, I suppose, loosely thinking. But the Financial Stability Oversight Council, which I think is a good idea in theory, doesn't really work very well in practice because one, it's run by the executive branch, and so it's when one administration comes in, they like the FSOC, the next administration comes in, they don't like the FSOC, so there's no continuity in terms of what the FSOC does. And two, all the participating organizations in the FSOC don't really want the FSOC to be successful, because if the FSOC is successful, it means the FSOC forced them to do something that they didn't want to do, and they're not going to like that. So the FSOC is a little bit like a kabuki dance. We pretend that we care about financial stability here, but it's very hard. I mean, I think the only time I can actually remember something being done, I mean, there's two things that the FSOC has done in terms of financial stability. One, they did the original designation of the systemically important institutions, GE, AIG, Prudential, and people thought that was mostly unsuccessful, but it actually was successful in one very important way. GE basically couldn't do what the regulators wanted them to do to be safe and sound,
And they de-risked.
and they basically got out of there. But they said this is too hard,
Right.
and they just basically got out of the business. So that was actually very successful. But the only other one that the FSOC did really was they put quite a bit of pressure on the SEC to do a second round of money market mutual fund reform. And the FSOC didn't do the reform, but they sort of essentially threaten the SEC. If you don't do something more, we're going to make this an issue. So I don't know. If you could somehow come up with a financial stability mandate that was broader than what just the central bank has, and that would be good. And sometimes the financial stability mandate is there, but it's just way too narrow. I mean, look at the FDIC. FDIC does not care about financial stability at large. It cares about financial stability to the effect that affects its FDIC reserve fund. During the financial crisis, I crossed swords a number of times with the FDIC about, no, your job is broader than just the FDIC reserve fund. You know, if the country goes down the tubes, the last thing we're going to be caring about is whether the FDIC reserve fund has been impaired or not.
Well, having sat around the table at FSOC, I certainly have a lot of sympathy.
I mean, I like the idea of
Yeah,
the
of course.
mission, but I don't think it really works that well.
Of course. Let's come back to the treasury market. It's not just lending in many cases. Sometimes it's asset purchases to address market dysfunction. So what are the criteria? How do you think about deciding where to draw the line? What's the difference between sort of normal fluctuations? We heard some discussion today about that. Nellie's conclusion was, we haven't seen anything really systemic going on. Where do you draw the line and how?
Well, again, I mean, the Fed has a lot of reasons to be intervening in the treasury market because it's the fiscal agent for the U.S. Treasury for number one. Number two, as we talked about before, there's no moral hazard problem in terms of supporting the U.S. Treasury market function because the benefits of that accrue to the U.S. Treasury. So the question is just really how bad do you think that to get before you intervene for market functioning reasons? And I think, the graphs that were shown earlier about, what's happening to market depth, what's happening to the bid-ask spread, what's happening to on the run, off the run, all those things are a measure of stress. I mean, really the question is, if I make a trade right now and then I want to do another, $100 million, how much of a discount do I have to take? And if the discount is small, that means market depth is good, and therefore I don't really have to intervene. I mean, I think the distinction between changes in prices due to changes in the macro environment, to the policy agenda of the administration, tariffs, for example, versus an inability to actually transact, actually move positions from one party to another. And I think, the Fed's view is, we should intervene when the market isn't actually functioning in terms of the ability to move money from one party to another. I don't really have a big issue with that. My criticism of the Fed, in fact, about their treasury market interventions, is they weren't very clear during the last cycle about when they made the transition from buying treasuries for market function versus buying treasuries for monetary policy easing purposes. If you go back and look at the record, it took them about 9 months to actually say, okay, now we're doing QE.
Exactly. And I might argue for a more subtle form of moral hazard in the sense that, if we go back to the idea that the first line of defense is resilience, and then the backstops are the last line of defense.
Yep.
Then if everybody knows the Fed's going to come in when you reach a certain threshold of pain, that defers all the conversations about resilience, and pushes them into the background, and the backstops become front stops. So that's I think an important issue.
Yeah, but if you said, if you don't come in at the first sign of stress, there's still going to be some cost. I mean, so look, I don't think anyone knows exactly like where the optimal place to come in on the tail is. That's sort of a judgment call. I would argue that the spillovers from the treasury market to other markets are also going to be important, right? I mean, if the treasury market is not doing very well, but the stock market says, well, we don't care, then that'd be a very different consideration if the treasury market was under stress and all other markets were melting down as well. I mean, COVID, it was a good example where it was very, very broad across the entire financial
It was
system.
no question about where the line was at that point.
Exactly.
Last, Linda discussed the role of dollar-denominated liquidity in the global financial system, the interplay of risks across borders. We all know that these issues are global in scope, despite the fact that we often talk about local jurisdictions and, this market, that market. Even the system-wide stress testing exercises, are primarily aimed at a particular jurisdiction. So, when we think about dollar-denominated liquidity, right? The Fed is the ultimate source of that. So is the FEMA facility adequate do we need to bolster it to make sure that, you know, that we've addressed any needed improvements? And how should central banks, you know, around the world coordinate their activities to improve cross-border resilience?
So when markets are good, most of the dollar, you know, transactions are done in the FX swap market and everything works fine. Private intermediary to private intermediary. But then when the market starts to get stressed and people start to run out of balance sheet capacity because volatility is increasing, then people start to pull back. And you know, then that's where when it makes sense for the Fed to come in to provide foreign exchange swaps to essentially, you know, provide that balance sheet capacity again, but this time for the dollar market. This is going to be a very controversial issue. I mean, I think it's a very controversial issue right now because
Absolutely.
I can imagine the Trump administration thinking this is not a good, this is a bad. Why are we bailing out these, you know, foreign banks by offering FX swaps? My own view is that the relative, you know, the cost benefit of a FX swap is really quite favorable because the credit risk you're taking is with a foreign central bank. And during the great financial crisis, I was happy all day long to trade domestic foreign bank exposure to the New York Fed and trade that for
ECB.
ECB. Yeah,
For the Bank of
I
England.
mean, we had some really chunky European bank exposures to the New York Fed that I was very happy to trade out of.
Understood. All right, is there anything we missed?
I'm sure there is. I mean, you know, I think, I mean, yeah, I guess the only other thing I really sort of focus on is two things. Number one, we also have to ask ourselves, what are the incentives that are governing people's behavior? And are the incentives that we have in the system aligned with how that we actually want them to behave? So I think, you know, that's sort of number one. Number two, what are the belief systems that people have that might turn out to be incorrect? Because that to me, it seems like that's how you have a really big source of stress. And number three, what are the sort of self-propagating mechanisms like the fire sale of assets that causes things to go too far? I mean, during the great financial crisis, at one point, education loans that were 97% guaranteed by the U.S. federal government were trading at LIBOR plus 300 basis points. So you know you got a pretty severe market dysfunction when
Something with a government guarantee is
yeah,
trading beyond the pay.
exactly. So I mean, you know, so there are definitely a number of things that I think you can definitely look at. But yeah, I think it's a very, you know, I think it's a very difficult question. I think the other thing you could do, frankly, is I think we need to think more about how to make banks competitive with non-banks. You know, I mean, I think like some of the stuff we have for the banking system right now, I think is just like nutty. Like the C card is just so cumbersome, so complicated. So, I mean, I just can't believe that the marginal benefit of the last, you know, 80% of the C card is really even worth it.
Not only that,
Especially given that it's only one particular stress. I mean, I would much rather have something that was a lot less deep, that was much broader in terms of the stresses that would cumber.
I've written a lot of pages about that issue.
Yeah, I mean, living will is another example. I mean, does anybody at any bank actually know what's in their living will? I mean, these things are like thousands of pages long.
Yep.
So I don't know. I think there's a lot of things you could do on the bank regulatory side to not so much wind back the regulations, but make them a lot easier and make them more consistent with how the bank actually does its own business. I mean, part of the problem you have is the bank runs its business privately like this, and the regulator comes in and says, well, you know, you need to do it like that. Well, it'd be a lot better if you could sort of merge those two things and only do it once.
Right, and that was one of the big benefits that Matt talked about in the SWES. And it, you know, raises the last point that I would like to make, which is, you know, instead of viewing these people as adversaries of each other, they should continually talk to each other.
Absolutely.
And think about how their risk management practices are aligned with what the regulators are trying to achieve, because at the end of the day, they have the same goals.
Well, except for one thing, the bank cares about its stock price a lot more than the regulator does.
No, I understand that.
But
the regulators should care about the stock price. I mean, we're
No,
talking about
that's
CS.
the point of Jill's presentation, that's not just about capital, it's about,
Right.
and right now we're having,
We gotta make money. in
we're
order
having
to
that
stay in
same
business.
discussion in Switzerland right now where the Swiss bank regulator wants to basically significantly raise UBS capital requirements because they view that the reason that Credit Suisse failed was because of lack of capital. And I think it's pretty obvious that Credit Suisse didn't fail because of lack of capital. They failed because of lack of confidence, lack of
management.
lack of management, poor culture, bad risk. I mean, a whole bunch
All
of
those
things. I really do think it'd be great to think about like how can you make banks more viable in terms of their competition with non-bank.
Yeah. Well, you and I have also talked about conduct and culture a lot.
Yeah.
And some of the things you can't legislate it, but we talked about some of the incentives that you can put in place.
I
And
think,
there's been some progress on
and I
that
think
front.
bank culture is better. I mean, I think people, so I think going into the GFC, so the front line didn't really think very much about risk. They thought about revenue. How can we make more revenue? If I make more revenue, I get a bigger bonus.
Yep.
And now I think, this is the whole 3 lines of defense for risk, front line has to manage its risk. The second line sort of oversees them, and the audit people are
The third line.
up third line. That's actually working a lot better. And another thing that's working better is foreign banks, and this has happened over and over again. Foreign banks finally understand in the United States that they actually need to identify their problems. I mean, for a number of years, foreign banks were like, well, Fed identified these problems, and so now we have to fix them. But they didn't really get that. No, the Fed doesn't really want you just to be able to fix your problems once we've identified for them. We want you to identify the problems and fix them before we come in. And that's taken probably, I don't know, 10 years to teach the foreign banks that this is how it's supposed to work. And that's how it should work everywhere. I mean,
Exactly. All right. Any questions from the audience? Right over here. Do we have a microphone?
I can speak louder.
No, it has to be recorded.
All right.
Sorry about that.
So Bill, I have a question, somewhat borders on what you're talking about. US Treasury has a massive challenge in the next couple of years, selling a boatload of treasuries. What, in your opinion, is the best execution in terms of potential buyers, who to target? Is it the banking system? It's the Fed? Is it foreign central banks? All the other best execution strategies, maturities, et cetera, what do you think?
well, I don't think the Treasury, when they auction off the treasuries, have a view like where it's supposed to go in terms of what segment. But that said, I think the Treasury could do more about building up their ability to buy back illiquid treasuries. And I think that's almost like a no-brainer. I'm issuing on-the-run securities that sell at a lower yield than off-the-run securities. So why not replace a lot of those off-the-run securities with on-the-run securities?
There's nothing standing in the way of them doing that. In fact, that's one of the 5 pillars.
They've already started a pilot program, but I think it'd be great if they did that at much bigger scale. I don't understand why you wouldn't just have an open desk that says, you bring this to us and we'll pay you this price, and it would make the on-the-run, off-the-run market a lot tighter. It would reduce risk in the treasury market. Treasury would actually save money in terms of its total financing cost.
Yep.
So I think that'd be an easy one to do.
Any other questions? Wilson?
Everything is working.
The exercise program is going great. Sort of a future question. There are a number of people who think that stable coins and crypto will become bigger elements of the real financial system, not just a sideshow. In a world like that, maybe 5-10 years hence, do you have a sense of what you want the relationship to, say, a stable coin to be vis-a-vis the central bank? Doesn't seem to me like Tether is a particularly great model as it exists today.
Terrible model.
So you probably don't want one of those. What would you think would be the right way to move down that track if that happens?
So first of all, we need legislation that sets the regulatory guardrails for stable coins in the United States, and hopefully we'll get it this year. 2, we have to define what a stable coin is, so we can stop the fighting in between, who has jurisdiction over it, SEC, CFTC, or should the Fed. I mean, I actually think if the stable coin is mainly going to be used as a payments medium, I think it really sort of belongs to the Fed. But no one's talking about that as the outcome. It seems to me logically that the Federal Reserve would be the one that you. I think stablecoins are coming, and I think legislation should basically require stablecoin issuers to backstop the stablecoins with, I would say, bank reserves, central bank reserves. I'm willing to include short-term treasuries, but I don't really want to include long-term treasuries because there's interest rate risk. And make it so that it's not like, well, we report every 3 months with an audit. No, you have to be, it has to be verifiable in real time, And, these guys are technologically savvy. I'm sure they could figure out how to.
They're technologically savvy, but they're, I'm sorry, they're not sophisticated financially, and they are interested in accruing rents to themselves.
So the second thing I would do about stable coins is the first iteration, I wouldn't allow interest to be paid on the stable coins. Because I really do think the first iteration, you want stable coins really to be a payment medium, not an investable asset. Because when you make the step to making an investable asset, then you have all sorts of additional issues you have to worry about. Like all of a sudden bank deposits moving into the stable coin, bank disintermediation, runs into stable coins away from bank deposits. So I think you want to probably be pretty limited in the first iteration, and then sort of see how it develops.
And the two things that are on the table, particularly the Stable Act, is probably worse than no regulation whatsoever, in my opinion. Mike?
Just a question on your advocacy for expanding the standing repo facility to non-bank financial institutions. What and the idea that it would be available, BAU. What would be the your thoughts about the counterparty risk, the margin terms, and does the CCP, the advent of central counterparty in the treasury repo market, affect that at all?
I don't know the answer to those questions, Mike. I mean, first I want to get people to just agree with the conception, the conceptual idea of why not backstop the treasury market more broadly. I mean, my point is, like, why is the standing repo facility only open to large banks and primary dealers? That doesn't really backstop the treasury market if those entities have no balance sheet capacity. So if you open it up more broadly, then the Fed's balance sheet elasticity can then apply to the financial sector more broadly.
But another way to think about your question is, what's the quid pro quo, to your earlier point, for giving access to the SRF to non-bank financial institutions? So could it be a combination of transparency? Could it be a combination of prudential oversight?
You can have definitely a quid pro quo.
I mean,
for sure.
I think that's the essence.
What is the counterparty risk and
Yeah.
Price risk or margin risk?
Right.
Well, I mean, I think, in all the things that we've been discussing today, I'm in favor of having margins that are relatively high during peacetime, so you don't have to move them during wartime. I mean, trying to get away from counter-cyclical, pro-cyclical margining is a good point. So you have a little bit less gearing in the system during good times, but that seems like a small insurance cost to pay to make it so you don't have to ratchet them up during wartime.
I spilled a lot of ink on that topic too.
I don't know why that's so hard to do. I mean, that seems like pretty straightforward.
Increases the cost of intermediation for those people who are getting the benefit.
Marginally.
Other questions? All right. One more? Yep. Colin.
Thank you, Dick. Hi, Bill.
Hi.
So two quick things. One, if you're around later, I'd love to talk to you more about some of the issues Treasury has with making the buyback program bigger. But my question is around this topic of potentially bifurcating the Fed's role as a regulator versus as a monetary policy setting institution, and your feelings about whether that's feasible, or if not, why not?
So there is this whole debate that very well may come up over the next year or two, with whether supervision should be taken away from the Federal Reserve. And that actually came up during the Dodd-Frank Act discussion. And what happened was the Reserve Bank's presidents mobilized people in their, their local congressmen and senators to sort of beat that back. but I think that could come up again. I mean, you know, if you look around the world, some central banks do bank supervision and some central banks don't. So there's no real obvious, you know, combination there. The argument for the Fed doing supervision has always been financial stability is important for the effective performance of monetary policy. So you don't have financial stability, you're not going to have an effective monetary policy. So you need to have a window into the banking world so you can ensure that financial stability is maintained. I think the Fed, in fact, doesn't carry out that mission very well because the supervisory regulatory piece is quite divorced from the monetary policy piece. And I'll give you a good example of that. When they introduced the supplemental leverage ratio, I made a point to people down in Washington that the fact that you did this is going to come into could come into conflict with quantitative easing. And quantitative easing will make the supplemental leverage ratio more binding. So maybe you don't really want to have reserves as part of the supplemental leverage ratio. And I was basically told, well, yeah, we don't disagree with you, but the train has left the stations too far down the tracks to unwind. And you know, I sort of had two reactions to that. One, that was pretty lame. And two, why am I, New York Fed president, making this observation? The Board of Governors should have made that observation and figured it out and made sure it never happened in the first place. So it's also very important that the central bank have good communications across these different verticals that they have. And we know that doesn't happen. I mean, a good example was when Silicon Valley Bank failed and we got the Barr report and Chair Powell was asked about it at the press conference. And he acted like he didn't have really much to do with it. It was all Michael Barr's problem. And in fact, it was a financial stability issue. I think the chairman of the Fed owns financial stability issues, not Michael Barr. So I think that it's important for the Fed to justify having that supervision, you know, mandate. I think they have to use it well. And I think that, you know, they haven't really used it that well.
Yeah, another way to say that for me is if you're going to take it away from the Fed, who are you going to give it to? And what kind of job are they going to do? And so it seems to me the answer is, and I've written a lot about that too, the supervisors just need to do a better job wherever they're located because they haven't done a great job.
Well, you know, part of the problem, you know, I mean, the argument against the Fed doing it, frankly, is, you know, every organization has a view of what their mission is. So NASA put a man on the moon. Fed, monetary policy. Supervision is not the primary, you know, resound existence of the organization. I think whenever there's goals that are sort of 3, 4, 5, they get less attention and suffer as a consequence. This is probably why around the world, you know, the UK is sort of interesting. They push it together, they pull it apart, they push it together. I'm not really sure what the right answer is.
All right, please join me in thanking Bill for a great conversation.